Trains will run on time. They take their job serious. Or some guess she'd probably have to take vacation or something to come do this.
Yeah, exactly.
There we go. My eyes. Yeah, that's right.
Well, good morning, everyone. It is 10 o'clock, so we can call the July 13th meeting of the Retirement System to order. Item number 2 on our agenda is to approve the minutes of the meeting of June 8th, 2023. I have a motion and a second. Please record your vote. Item is approved. Item number 3 is the consent docket. We have 3 items. I have a motion and a second. Please record your vote. Item is approved. Item number 4 is to ratify approvals. I have a motion and a second. Please record your vote. Item is approved. Item number 5 is to approve the claims docket. I have a motion and a second. Please record your vote. Item is approved. Item number 6 is to approve the following applications for service retirement. I have a motion and a second. Please record your vote. Item is approved. Item number 7, receive report of death, authorize payment of the $5,000 death benefit, and authorize secretary to make necessary changes to conform on the following. I have a motion and a second. Please record your vote. Item is approved. Item number 8 is items for individual consideration. We have one item. Item 8A is affidavit and agreement in regard to the employee contribution of Earl Kirchberg. Any questions on this item? Hearing none, Chair will entertain a motion. I have a motion and a second. Please record your vote. Item is approved. Item number 9 is to receive the investment consultant report. Good morning, Jason.
Morning. Moving right along. I don't have a lot to report this morning, but I'll just touch on the portfolio through June. I think as I talked about last month, a lot of folks might be surprised looking at June numbers, how good trailing 1 year is now. I know you all are a 12/31 fiscal year, but for those plans that have a June fiscal year, things aren't going to look too bad. Through the end of June, if you go to the next page there, Regina, you'll see up in the upper left there, as far as market returns, the light blue bar is calendar year to date, and the dark blue bar is the month of June. So June was a really strong month. We got past the concerns about regional banks, kind of got through that, about the federal budget, got through that. The Fed held rates steady at their June meeting, although the expectation is probably see a couple more raises as inflation continues to be a bit sticky, but certain signs are definitely coming down. The GDP number for the first quarter was revised up quite a bit to 2%, leading to a really strong month in the equity markets. To just bring you forward through yesterday, year to date, the S&P is up 17.5%, so about another 0.5% in the month of July. International is actually, international developed is the best performing asset class as measured by the EFI on a one-year basis. On a trailing 1 year through yesterday, international stocks are up 21%, and the S&P is up 19% through yesterday on a trailing 1 year basis. And this is something that we've talked about for a few years, as really the last decade has been dominated by U.S. Equities, particularly large cap growth and technology, and non-U.S. has lagged. But as the dollar has, a lot of that hasn't been due to poor company performance, it's been due to the strength in the dollar. And the dollar has weakened, and that ebbs and flows over time, and that's why we believe in that diversification, global diversification, and you're starting to see the impact of that. Fixed income, slightly positive on a year-to-date basis through yesterday, up about 2%. The trailing 1 year is down now through yesterday. This isn't on here, but you'd see the ag there down 40 basis points. The trailing 1 year is down about 1.29%. Just to remind everyone, at the end of calendar year 2022, the ag was negative 13% on a 1 year basis, and that's because we saw rates go up dramatically. You didn't have that cushion. Bond prices came down today, and as we began the year, we're in a much better spot, and so longer term returns are starting to moderate. And as we go forward, that just as a reminder, that lower left, those are our capital market assumptions, the median capital market assumptions for various asset classes. And this is quite a bit, about 2% higher across the board in every asset class from where we were at the beginning of 2022 or 2021, because yields are higher, valuations had come down. Where we sit today, however, the middle of the page here, we do believe U.S. large cap is pretty expensive right now, particularly technology, as we've seen a lot of these technology names rebound and really blow through where they were pre-2022, prior to their prices coming down. We talked about this last month, seven stocks in the S&P 500, the NVIDIA, Tesla, and Apple, Meta, or Facebook, and Google, they contributed about 100% of the return through the end of May. That's spread out a little bit more. We're seeing a little bit more breadth in the market, but those valuations are pretty expensive. So from a near-term standpoint, and not that we do anything with this, we're not being tactical in your portfolio and trying to take away from things that are expensive. We rebalance based on your strategic asset allocation, primarily for your cash flow needs. But large cap looks expensive right now. Small cap and international a little bit more attractive. Continuing for, we haven't seen where we've shown cash and core bonds to be undervalued for some time. That's actually an area where you can be compensated right now fairly attractively without taking too much risk. And not that we're allocating to cash, but as you raise cash and hold cash for capital calls and benefit payments, it's not you're not being penalized for that now in the short term as we might have been over the last decade. Just looking at the asset allocation on the next page, slight overweight to equities. That's really coming from slight underweight to fixed income, and really a slight underweight to real estate. And that real estate, we've increased that target within the last couple of years, and we're really just moving toward it, as real estate in 2022 held up nicely. This year you're seeing markdowns in real estate portfolios, although the Morgan Stanley Prime Property Fund, which is your primary core holding, relative to the benchmark, is held up fairly well. A little much lighter on office than the benchmark, which is a positive. Certainly seeing office, commercial office and private real estate in some portfolios marked down as much as 60-70%. It's pretty challenged right now. as Morgan Stanley has talked about when they've been in and we've communicated, they've really been transitioning that portfolio since pre-COVID, lightening up on office and retail and increasing their exposure to multifamily and industrial or warehouse space, which has done a little bit better. Just going to the next page, looking at returns, you'll see your 1-year return now, net of fees, about 7.75%. So now back up above that 1-year return above your hurdle rate. 10-year return back up above the hurdle rate of 7% net of fee basis. That had dropped down a little bit under 7 at the end of last year. If we went back a year before that, you'll recall that 10-year return was closer to 9% annualized, and what 2022 did was really erode some of that. But as you heard last month from your actuary, your funded status, because you're looking from a funding standpoint, you're measuring at a single point in time at the end of the year, and you're not capturing all of the gains in every good year, and you're not experiencing all of the losses in every bad year. You still got the good years of 2020, 2021, 2019, 2020, and 2021 offsetting to a large part what happened in 2022. The one thing that Louise talked about last month is we'll still wait to see where we are this year. You know, where you finish this year will have an impact because you'll have to recognize some of the loss, more of the loss from last year. So hopefully we keep that up above that 7%. Trailing the policy index a little bit, and it continues to be a couple of areas. One is large cap, which we've talked about quite a bit. You're primarily benchmark risk controlled. However, the Intech component of large cap, which is about half, while they own the stocks in the Russell 1000, the large cap benchmark, they're not cap weighted. It is a mathematical process in which they're weighting those stocks in that portfolio, more heavily weighting those stocks that have more price volatility, which tend to be the smaller stocks in that. So you have greater diversification away from the mega cap names, and that's been a bit of a headwind. And so that's really where you're seeing that dispersion in your large cap composite relative to the S&P 500. While still up 18.5%, your best performing asset class on a trailing 1-year basis, that dispersion relative to the policy is coming from that. The other component, small cap, has done a nice job. Added your 2 small cap managers in Earnest and now Silvercrest, who replaced Times Square, which had some turnover in the team, adding about 200 basis points. Private equity, this is creating some dispersion relative to the policy index in the short term. Last year, in 2022, private equity valuations don't track public markets, so private equity was up when public markets were down, or just holding value. We weren't seeing write-downs. The first couple quarters of this year, we've seen write-downs, particularly in the venture portfolio, flow through into the portfolio marks. And so relative to a long-only benchmark, which we're comparing private equity to in your policy index, it's going to lag in the short term. Longer term, the purpose of private equity is to provide a premium return to public markets. Really measured in the short term isn't meaningful. If you look out over the 10-year period, your private equity is your best performing asset class, really double the return of your total portfolio, up 15.5%, where your total portfolio is up 7%, and your large cap equities are up 13%. So we're getting that premium there. On the non-U.S. equity side, a little bit behind here. A lot of this was last year, 2022. The same thing was happening in non-U.S. markets as was happening in U.S. markets. As growth sold off, that was a headwind to the Harding Loevner portfolio, which is a little bit more growth oriented. Value outperformed in 2022, but that was almost exclusively energy or oil companies. And so a lot of value managers, U.S. and non-U.S. active value managers, had a hard time keeping up when energy was the only sector, and particularly oil, that was doing so well because they were underweight that sector. Unless you were overweight that sector, that was a challenge. And Lazard, while value bias, more of a core strategy with a value bias, underperformed the value benchmark, and that's where some of that's coming from. All in all, no manager concerns or issues. It has been some time, and I think I mentioned this last month, but I think next month, I'd like to bring a manager in. I don't know that you have a lot on your agenda, so maybe we bring in Lazard, the one I just mentioned, just to give an update. I think it's probably been a couple of years since we've had them in. The other thing I handed out for information was the conference agenda. We've been working with Regina and others on organizing the conference in September. We feel like we've got a good agenda put together and a good 3 days of camaraderie, education, and hopefully some good social activities. It's coming along very well. So I passed out the agenda for everybody to see. It's got some new speakers on there that we haven't had in the past, some familiar names as well. And really all of your managers have been supportive and trying to give them opportunities to speak as well.
All right. Anyone have any questions for Jason?
Yes, sir.
I noticed that the currently we're underweighted in private equity, international developments, and emerging markets. I understand it's not a tactical strategy, but why the underweight when they're expected to outperform the U.S. large cap?
Some of it is we're certainly well within ranges, and the rebalancing mechanism is primarily from cash flows, as you need to raise cash for operating needs on a monthly basis, so we're not constantly trading and incurring trading costs. That's the primary reason. Private equity, it's because you've increased the strategic allocation from 10 to 15%, and it's not something that we can just move money into. That we manage via a pacing plan by making commitments of so much per year, knowing that it's going to be 3 to 5 years before we get there. So where we're raising money from, where we continue to raise money from now for your operating needs has been U.S. large cap.
Okay. Thank you.
Any other questions? Okay, hearing none, Chair will entertain a motion to receive the investment consultant report. Have a motion and a second. Please record your vote. Item is approved. Item number 10 is comments from board staff and citizens.
I would like to recognize our new trustee, Doug Daller. Welcome him to the board.
You stole my thunder.
I'm sorry. So I've had the pleasure of working with him for 25 plus years, and we have a good addition here. So
I'll second that.
Well, thank you all. Appreciate it. I'm looking forward to this. I'm excited about being on the board. So thanks.
Thanks.
Welcome, Doug.
I just want to take a second. I know everybody's probably aware, but there's a ton of work that goes on behind the scenes that really, I'm the only one that really knows about it because I get the emails and I work with Regina on getting documents signed, et cetera. But I just want to publicly acknowledge Regina and her staff and Dick Mahoney, our assistant municipal counselor who is involved in all that, and Matt Boggs and his staff in Treasury, and the folks in accounting that help us all, because without them, we couldn't do it. And I know, there's only a few of those folks here, but I just want to take a minute and publicly acknowledge them for all the work they do on behalf of the system. So,
Thank you.
anyone else? Okay, we are adjourned at 10:19.